Today I'm going to talk about usury and lending money at interest. Welcome to Missing the Mark, where we look for meaning in strange places. I'm Christopher. So the English word usury it used to mean just lending money at interest, and in more recent times has come to mean lending money at very high interest rates, generally speaking like unjust interest rates. And so there's a bunch of discussion about this because, for example, you can find, in the Old Testament, you can find various kinds of limited prohibitions on lending money at interest. Basically, like Jews weren't allowed to lend money at interest to each other, and there's also a prohibition on lending money at interest to poor people. And you can also find a more general reference in, if memory serves, it's Ezekiel. But I mean, within context, it's a reference to the previous actual prohibitions you find in the Torah. It's not a new thing unto itself. You can also find in the patristic period, you can find some condemnations of lending money at interest, and you can also find this various condemnations of it within the medieval church. And now, in the present context, you find lending money at interest is one of the major cornerstones of modern economies. And so what's going on? Are we simply throwing away the parts of the faith that we don't like? And the answer is no. No, it's not. You'll find people who will yell and bang about this, but the thing is, if you actually look into what's going on, look into what is the reasoning, what is the motivation, what are the conditions in which this is happening, and what is lending money at interest actually about, and also what are the alternatives. And I'll get into this because one of the big things that you will find is that lending money at interest, you can do the exact same thing, except it's not interest, it's a number of other fees and other such things that can work around it, that work out to be the same but less convenient. And so I'm going to talk about some of those because it's in those we will actually see what lending money at interest is in the modern economy and why usury in a modern sense gets defined to be lending money at excessive interest, and how that does actually correspond to the thing that was prohibited in the more ancient world, which had a wildly simpler economy. Okay, so if you look at it, the basic prohibitions on lending money at interest, they have the basic structure of you give somebody money for some time, he is duty bound to give you that money back plus some extra. And if you look at if you look into the few records we have, like the sort of things that get condemned, the sort of money that was being charged back was really quite remarkably high, actually. Anywhere from 15 to 30% and or 50% interest in a relatively short period and so on. And a lot of what these things were doing, when you look into what's going on, is it was a predatory behavior. It was taking advantage of somebody who is in a difficult situation. And in that difficult situation, saying like, okay, I'll give you the thing you need now while you're in distress and everything's going to go horrible for you and you'll do approximately anything. But in exchange, I am going to take a lot of things. And you can see the same basic thing actually in stuff like selling somebody into slavery. That a person might sell themselves into slavery in order to pay off some very pressing debt so as to avoid something like going into debtor's prison. You would you would then or worse you would then sell yourself into slavery to have the money to pay off your debt, and now you're a slave, and this is a person very much taking advantage of you. And so you see that, and that stuff is very obviously bad. Taking advantage of somebody in their desperate need and not helping them, but taking from them, using that circumstance to take from them as much as you possibly can, is indeed a vile and despicable act. Okay. And that's the sort of thing you actually, when you see specific things being talked about, you see that very kind of thing. Sometimes, with the pretext of helping somebody, sometimes not, but just trying to take advantage of somebody's need. Now, let's look at an interesting thing. No, by the way, you will sometimes see, like, St. Thomas Aquinas had a thing about how the use and the consumption of money are different, and so charging somebody money for the use of the money is in fact double charging them for the same thing. And there's an aspect in which this is correct. However, there are a lot of things, there are a number of things that can exist, which in the simpler economy of what St. Thomas was talking about, aren't, can look like this. And in fact, he treated separately. So, as an example, investing in somebody's business, that is is a thing for which it entirely makes sense. Like, I will put up money into our investment in, wines or whatever, like shipping wines over to England, and then in exchange for me putting up the money so that you can buy the wine to go bring it to England, I will get a portion of the profits that you make when you sell that wine over in England and come back with that money. That, a form of investment, is entirely legitimate. Now, how is this different than lending at interest? Well, but when I say the profits, I don't mean the net profits. I mean the gross profits, as in, you buy, let's just keep the numbers really simple. You buy 10,000 gold pieces worth of wine here. You ship it over to England and sell it for 20,000 gold pieces. I put up 10,000, say I put up 10,000 gold pieces. You come back, you give me 15,000 gold pieces, and you keep 5,000 gold pieces for yourself. And thus, I get a share of the profits that is, divided between the labor and the amount of money put in and so on. Now, how is that different than I lend you 10,000 and get 5,000, and you repay me the 10,000 plus get 5,000 back? And the way St. Thomas actually distinguishes this, back in the Middle Ages, is that you are not on the hook for this no matter what. This is not, there is a risk that I am bearing in the use of this, in the buying of the wine and the use of this money. I am bearing the risk that stuff could all just get sunk at sea. That would happen sometimes. Bad weather hits, ship breaks up, the wine gets lost, and I'm just out my money. It's possible we won't be able to sell it for nearly as much as we thought. And whatever the result of what we can do, I get back the, roughly like 3/4 of it, say. That's the arrangement, that like I'll put up this money and I get 3/4 of whatever we can sell this for. And you get to keep, 1/4 for your trouble. That kind of investment would be entirely reasonable because I am bearing risk in the thing. This is not a loan of money to you where I'm guaranteed it back and I can send you to debtor's prison for it. I am bearing risk, and so it makes sense that I, in bearing this risk, get compensated for the bearing of this risk. So you can see that. You can see a number of other things too, and this came up as in like the later Middle Ages, if memory serves, or it might be sort of more towards the Renaissance, where things start to get more complicated. And you start to see things like credit unions. And the thing about it is, like, if I deposit my money with you and then want to be able to, say, draw money out someplace else or write checks against this money and so on, that's work that you're doing when I deposit my money with you. And so it makes sense then for me to pay for this. And similarly, on the flip side, in credit unions, if I go up to if a bunch of people pool their resources to be able to lend this out, or, if people pool their money, say, and then say, what, like, this money just sitting here in a vault isn't really doing us any good, so we might as well lend this money out. And they do so. They lend the money to somebody who uses it for time and then returns it. Well, the thing is, the people who have to actually administer it, who have to go and do the work of administering it, of keeping track of where it is and keeping track of the repayment and and so on, they are doing work. And it is entirely just that the people doing work here be compensated for the work that they are doing. And so it is just that the people who are doing this work receive some sort of fee from the people who are borrowing from this, even though they're not paying additional, they're only going to return the amount that they borrowed when they want to use it for some purpose. But like, they're incurring work on, for other people. Now, there's another thing, and basically another thing that kind of comes up as economies get far more complex and the ability to invest in business ventures multiplies, because it's only really, painting with a broad brush here, it's only really like in the later Middle Ages that you start really seeing business ventures as such, the ability to, make goods and sell them, and transport things in distances, and make money by bringing people utility and selling things to people who need them at a distance, and so on. All of this stuff, it's only really getting going in the later Middle Ages. And by the Renaissance, now technology has advanced to the point where transportation is actually working quite well. And there's enough technology going on that there are a lot of useful things to actually be doing. There are a lot of things you actually can start trading. As you start getting into by the time you're hitting the Renaissance, the technology that was developing during the Middle Ages, things like clocks and reading glasses. It's kind of funny. Like, people talk about a lot of the scientific revolution is really the ability to measure things more accurately using technology developed during the Middle Ages. And as soon as this technology really exists, people start using it. So, for example, there's the refinement and development of reading glasses, which is where lenses like that really started getting used, was in reading glasses. And then over time, people figure out, you can use these things to see faraway objects. Thus was born the telescope, which was usually literally a metal rod holding two lenses up. They weren't really great at first, and they got improved over time. But a lot of the revolution in astronomy came pretty directly after the development of, wait a minute, if we put these two lenses kind of, far apart like this, you can see things far away and they look close. This will really help us look at the stars. And the moment you do, that's the moment anybody has this piece of technology, well, the astronomy goes better. Well, okay, these things are developing during this time, improvements in steel and better steel, and you start seeing, in England, they start really harvesting coal, for example, and now you've got plentiful sources of fuel in a way that wood was never nearly as plentiful and so cheap, and then that enabled better steels, and this enabled all sorts of different things. You get, things like clocks. It's during the Middle Ages people develop clocks, etc. And so it's only really as these things get worked out, and they also enable people to do other things. Like when you make better steel, there become all these different inventions that become possible to make now that you have cheap, good quality steel. Whereas when all you had was expensive, lower quality steel, there are lots of things that simply wouldn't work. So there's a multiplicative process intrinsic in the nature of technology, that technologies enable more technologies, and you get a sort of blossoming out. And it really historically has very little to do with people coming up with new theories of knowledge. It has to do with the fact that technology enables other technology, and it has a sort of exponential, it's really the beginning of an S curve, but sort of exponential growth to it. And it's really only in the later times that we see this. And once you're into that heavy sort of exponential growth, once you have things like people who can specialize in the making of nails, and people who can specialize in the making of clocks, and people who can specialize in the nature of making of watches, and people who can specialize in the making of this multitude of technological devices, trade becomes a really big thing, because of course skilled watchmakers can set up a shop to make things, and they can make them much, much more efficiently than can people who did not set up their shop to do this very thing. Fun thing, making bowstrings. It's funny how sometimes the simplest things can drastically improve your productivity. But I took the time to take a dowel and essentially put a semicircle on each edge so that it can just hold the string apart for me, so I can easily wind the serving onto the string. And it made me 5 times as efficient as having to sit there and use my hand to hold the thing apart, and wasn't really very good. Just take this thing, put it in there, and wow, did I become so much more efficient. And it's, tiny little piece of wood with, it's not high technology, but it is exactly the size and shape that I need, makes me so much more efficient. And so it is with the manufacture of goods, that if you specialize in the making of these things, you set up a shop dedicated to making them, you can make them better and faster and cheaper than, and literally get all three. That's the amazing thing about specialization, is that you can get better, faster, cheaper than somebody who does a wide range of things and doesn't have any of the specialized tools. As you have the many different things that you can actually specialize in, where it makes sense for lots of different people to specialize, they're not going to all specialize in the same place. And then there's a tremendous amount of utility involved in transporting things for people, and bringing stuff around and collecting them into one place, buying a whole bunch of them and then reselling them to the individual people who want them in some other place, things like warehouses and so on. So that this stuff becomes tremendously valuable, and there becomes a wide range of things to do this in where you are providing this sort of value to people. And thus, it's really only in the late Middle Ages that you start to see the beginnings of a complicated economy in which investment becomes commonly accessible. Because the thing is, like, if you go back to the ancient world, if you're at the time of, like, the ancient Romans, what would you invest in? I mean, there's not a whole heck of a lot to invest in. Like, they're blacksmiths and stuff, but, like, it's a lot simpler. The blacksmith is sort of a multi-purpose thing, and for the most part, you don't invest really in that sort of way. Like, you have to, like, apprentice for a long time anyway, and you earn your way up essentially to having your own blacksmith shop. In a lot of cases, you do that by way of you work in your father's blacksmith shop, and then eventually you inherit it. And, people go and make new ones and travel to new places and so on. But, like, it's not real common. It's not a real big thing. There aren't these opportunities all over the place where if you have some money now, you can do something really useful to provide a lot of value to a lot of people and make a lot more money back in exchange for all of that value that you gave to them. And so it's really only with the specialization of goods, such that there become a wide array of things where a lot of different people can make them better, faster, cheaper by specializing in them, and that you get things like providing a ton of value by being able to be the intermediary, because not everybody wants to travel to the one city where they make watches really well, and also really high quality watches much cheaper than other places. And so, like, you taking watches from here, giving the watchmakers the money so they can keep on making watches, so you essentially spot them the money for a while, and then travel to different places and sell them these watches, clocks, or whatever. You're providing a ton of value to people, but it's only in the range of specialization and when travel becomes widespread and safe enough pardon, that doing this sort of stuff really provides a ton of value all over the place, constantly. Like, the thing is, like, there's never a time when there wasn't trade. There was always trade. There's always, taking spices from one place and bringing them over and, selling them, etc. Like, there was always trade. I'm not saying there wasn't trade or the trade started in the Middle Ages, but there was an explosion of trade that happened that was not just in, like, fine luxuries, but starting to become in widespread and extremely useful things all over the place. Once you have that, you now have a giant array of things that can be providing value for people. So if you have, if you had a great crop and made a lot of money selling your crop into, say, a city, because you had a ton of it to sell, then you now, instead of just like, well, you've got a bunch of gold, and so, okay, you have to keep it safe until you finally spend it, that's a very different circumstance than, okay, now I can then invest this, lend this to people for the carrying on of business, providing value to people, and then recouping money from this value. And so the thing is, if someone wants to borrow money, it's a lot less, you don't just have money lying around, because you wouldn't leave it lying around. You would actually have a good use to put it to where it is providing value to people. And so what you get is the concept of opportunity cost, where, okay, I can lend you this money, but I would be investing it and making money off of that. And so in exchange for me lending you this money that I would otherwise invest, you should compensate me for the money I am not making by not investing this in a useful business thing. That in order for me to be allocating the money in this way, you should be compensating me for what I could be doing with this thing, because I would in fact be doing it with that. So there becomes the concept of the opportunity cost, and essentially there is now something useful you can be doing with the money at all times. And so money shifts into essentially, though not literally, the same concept as anything else you might rent, in the same way that, like, I might have a vineyard and rent this out to people, where you can work the vineyard, and then at the end of it I get half the produce of, what you grew on my vineyard. And rent, by the way, is a thing with which you will not find you can find condemnation of excessive stuff, but you will not find any blanket condemnations of rent anywhere within the history of Christianity. Now, I mean, point of fact, Jesus himself likened God to a vineyard owner who rented it out to people, and the people who did not want to pay their rent were the bad guys in this story. Just as a minor thing there. So money then falls into that same category because you can use it profitably. Now, so another thing is, and I'll sort of bring this in, there become a lot of services, essentially, that end up getting rolled together. Because the thing is, investing is, when the economy is at a certain level of complexity, then it becomes convenient. Like, if all you want to do is buy, I've got a ship, I just need to buy the wine to transport. Okay. You know, especially at a time when people would, be willing to work on a ship for a while and then eventually they'll get paid at the end of it. Okay, that kind of works. As things progress in complexity, the sort of investment that you would need gets really complicated. And the sort of investment, they consist especially of like lending things for a particular purpose and so on. The other thing is because, some people may need a very large amount of investment and there would be very few people who have enough to invest, but a lot of people have small amounts to invest. What becomes very useful is the ability for large numbers of people to pool small amounts of money into larger amounts of money, which then they can invest together. But, and this is the thing, on the flip side, for a lot of things, like, what they're looking for is, they're looking for an exposure to risk that they're willing to bear some risk, but they don't want to bear the full risk of what's going on because they don't, they can lose a little bit of money, but not a lot of money, and they like to make some money, but also not a lot. And so what they start trading off is essentially, okay, how about this? How about I invest in your thing, but I'll invest in your business venture, but in a limited way where I get repaid first. So that but at the same time, the amount of money I make from this also gets capped. So I'm investing, but if whatever money you do in fact make out of this business venture, and we're not looking at ones where like your entire thing can get lost at sea. We're looking at stuff like I want to set up a watchmaking shop and make high quality watches, where it's not going to just the odds of it getting completely destroyed are not real high, like in sea-going ventures. Okay, and so you then basically say like, okay, so we want to invest, but how about, we'll provide you with some of the money, which will be very useful to you, but we want to get repaid first out of this so that you bear more risk. And in exchange for you bearing the more risk, we're not bearing zero risk, we're bearing, smaller amounts of risk here. We'll also take a fixed amount of profit on this. So how about, we invest this amount of money, and then you repay it plus a few percent, and that will be our profit. For the small amount of risk that we take, we get that, but we don't get any more, and you take the rest of the risk, and so you get the rest of the money. And that's lending money at interest. It's also investing with a limited risk and therefore limited reward potential. There's another thing that comes into the modern world, and there's actually kind of an interesting irony I may get into about things like the gold standard. Because the thing is, a lot of the people who, all right, I will get into it. A lot of the people complain about lending at interest are, frankly, people who owe money that they don't have and can't really foresee themselves having in the near future. There's a lot of, not the arguments that are put forward, but rather the table thumping. There's a lot of motivated table thumping that you see. And so I'm kind of referencing, there's a supposedly an old lawyer's adage, if the facts are on your side, argue the facts. If the law is on your side, argue the law. If neither is on your side, bang on the table. And I'm kind of referencing that as table thumping. The thing is, a lot of people who do that table thumping, who owe a lot of money and are unhappy with this fact, because I've been in that position like 20 years ago. I owed a bunch of money and it took me a long time to repay it, and finally did. Very unpleasant. It's very, very unpleasant. I'm very sympathetic to people who owe a lot of money because it sucks. It really, really does. And thing is, for those people, even if they had to repay their loans with zero interest, they would still be really screwed because they still don't have the money to repay the principal. And the other thing is, if they had borrowed the money in gold and had to repay in gold, they would be even more screwed. And there's kind of an irony because these are people who often these days talk about the gold standard. But if you go back to when people were getting off the gold standard, who were some of the biggest proponents of getting off the gold standard? Borrowers. Hence the the famous in within America, we can't we shouldn't crucify our farmers on a cross of gold. I think that was Williams Jennings Bryant, who famously said that one. What was he talking about? Farmers owed a lot of money, and on a gold standard, they had to repay that money in gold. And so their loans kept their value over time. Plus or minus, gold's not actually stable, but fairly stable. And what they really, really wanted was to get off the gold standard and inflate things so that the amount of value they repaid was much smaller than the amount of value that they borrowed, since they would, as the currency inflated and you have a lot more dollars around chasing the same number of goods, the price of everything goes way up, and so you make a lot more nominal dollars. Your actual buying power becomes the same, because like if you have $1 and the loaf of bread costs $1, or if you have $10 and the loaf of bread costs $10, you can still buy one loaf of bread. Your buying power is identical. The numbers are just accounting. But if you have $2 and the loaf of bread costs $1 and you owe somebody $1, you can buy a loaf of bread and pay them back $1. If, however, you have you have $20 and the loaf of bread costs $10 and you owe somebody $1 because you bought it before there's more money chasing and the prices went up. Now, after you pay them back $1 and buy that loaf of bread, you have $9 around to buy another, 9/10 of a loaf of bread with. So you're much better off. And so the farmers wanted to get out of repaying their debts by inflating the currency so that the value of individual dollars went way down and they would still repay their loans in the nominal dollars that the loans were denominated in. And so basically they would just cancel their debts without actually defaulting on their debts. That's basically what they wanted, and that was one of the things within America pushing to get off the gold standard. Ironically, the same people who want to get out of their debts nowadays talk about wanting to be on a gold standard for various kind of amusing and historical reasons. But anyway, that relevant digression aside, the thing about it is that, and what it does bring up that is also very relevant here, is that we live with inflationary currencies. The amount of money that exists to buy goods and services is constantly going up. And it is constantly going up at a rate that is targeted at about 1% more than the goods and services to buy, such that the price of these goods and services increases by about 1% per year. That's the target. It's between about 1 and 3% per year. Here in the United States, that's what it's been targeted, and sometimes it goes a lot higher. The 1970s had a big spike. There's a bunch in like the 40s that had a big spike and so on. Governments, by the way, also love to repay their debts by massively inflating the currency and then repaying in nominal dollars, or nominal whatever the heck their currency is, because this way they just don't have to repay it. But it's not nearly as ugly looking as when they just say no. Anyway, that's why governments always have a big incentive to inflate, and why, incidentally, there actually exists the Federal Reserve System of the United States, which is very interesting. The thing that can actually create money, the Federal Reserve Bank, is as independent from the federal government as basically the people devising it, who made it, could figure out how to make it. So, like the people who run the Federal Reserve Bank are appointed through a somewhat complex system and very, very infrequently. And they've got a bunch of incentives that largely amount to, that insulate them from the pressures of how the government just wants to inflate away its debts. And so like they're tasked with other things, and the incentive structure for the Federal Reserve System is actually, it's a government entity, but it also has some curious things where like the large banks are actually depositors in it, and they actually do have some amount of say in what goes on. It's a limited sort of sense because it's created by the federal government, but this whole system was designed to insulate the creation of money from the way that all governments always want to inflate away their, they want to take on debt and then inflate it away to just like sort of magically get rid of their debt, because it's just so much nicer that way if you just don't have to pay your debts. So that's why the Federal Reserve System exists, and exists in the way that it does. It was designed to try to keep this. And the Federal Reserve has largely been targeting between 1 and 3%. Essentially, really, they're targeting between 1 and 3% price increase. inflation referring to the inflating or the increase in the money supply. And so they're increasing the money. Their goal is to increase the money supply faster than the available amount of goods and services, or to maintain it in such a way that the increase is about 1 to 3% above the goods and services, so the prices keep on creeping up like that, the increase in goods and services. Because the thing is, if you have an increase in number of goods and services and your dollars stay the same, the prices on everything have to go down because these dollars are now chasing more things. And so you have to, the prices on everything have to come down in order to be able to use the money to buy the things. And so what you really ideally want is an exact matching of the growth or shrinkage of your money supply to the goods and services you can buy with it, such that prices would be completely stable. Phenomenally hard to achieve, and there are various reasons and various economic theories why, like the Federal Reserve System and a lot of other central, like European central banks, target this like 1 to 3% price increase per year, inflation to that. With regard to loans, and the implication this has on loans, is that if I borrow $100 from you today and I repay it in a year, and there's been inflation such that prices creep up by 1%, in order to repay you in the same borrowing power that I borrowed, the same spending power that I borrowed, I would have to give you $101. Now, is that me paying you interest? No, that's me giving you back what you gave me. And you can see this very clearly if we instead, if we pretended for a second, if you will indulge me, that gold prices don't fluctuate on speculation and were simply to be a stable commodity, the price of gold would go up by 1 to 3% each year, as inflation does. And so if the loan was denominated in gold, as in like, I give you, you give me 1/10 of an ounce of gold, and then in a year, I have to give you back 1/10 of an ounce of gold. So that, I then sell it to get the money that I want, do whatever I want with it. At the end of the year, I have to buy 1/10 of an ounce of gold and give you that 1/10 of an ounce of gold. You would clearly see, I would be giving you back exactly what you gave me, 1/10 of an ounce of gold. It would be a loan repayment with 0 interest. But I would have to spend more money at the end of that year to buy that 1/10 of an ounce of gold than I do now because we live in an inflationary currency. So if we simplify and don't make people constantly go to the gold dealer, but denominate things in dollars, what you have to do is your best to figure out, okay, what is the actual amount, over the loan repayment time, what is the actual amount that you would just be repaying me exactly the buying power that I lent you? Okay. Now, on top of that, what we see is basically a bunch of the things that I had talked about, such as standardized, basically renting the money, paying for opportunity, compensating somebody for the opportunity cost, compensating the people who are lending you for the fact that because they're doing a lot of lending to a lot of people, they employ people to do these jobs, and these people are doing work and therefore must be paid for their work. And the amount of work they do, how do you distribute this? And it makes a lot of sense that like people who borrow more money should pay more of the salary of the people who are doing this because they're using more of their services, not strictly in a temporal sense, but in a why are they here sort of sense. Is like, does it really make sense if I borrow, $5 that I should pay, exactly the same amount as somebody who borrowed $100,000? Not really. I mean, it kind of sort of does in one sense, because like we both are at the teller for the exact same amount of time, and if the two of us are the only people who come to the teller this day, in theory, each of us should pay half the teller's wage. But on the other hand, if you really want to think it through, and my point is that this is so complex that it just needs to be simplified for practical reasons, if you really think it through, you then would need to say like, well, but everyone who might possibly come in and speak to the teller really should be paying a fraction, that fraction of the teller's salary, because they want the teller there even if they're not going in that day, because they want the ability to go in that day, so they should all be paying for it. So in some sense you should have, divide it all out amongst the people, but then you would really want to, figure out like, who wants what convenience and how much of a fraction they should pay and so on. And it's really, really complicated. And at some point in this fallen world, given that we have limited amounts of time and intelligence and effort and memory and sheets of paper to keep track of it on, a lot of this stuff, if we just approximate the thing with like, here, we're just going to charge this, or, we're just going to charge 1/10 of 1%, and that's going to cover the costs of the money that we lend out, because we know how much that's going to be, and that's going to cover the costs. this will be born in such a way that, is this exactly how it should be? No, but this is pretty close. No one's being significantly cheated. It'll probably kind of balance out because, people do different things. And we being fallen human beings, we're probably not going to get much closer than this anyway. So let's make everyone's lives a heck of a lot simpler. And the people who are being overcharged will at least be compensated by their life not being so much more complex for dealing with the complexity of trying to get this a little more accurately. Okay. So you get things like the charges for like all the people who have to administer all of this stuff and have to be around and have to be there all the time. And so they need to be paid a living wage and, just compensation for their services and so on. And there are a bunch of them when you start having lots of people who might want to borrow at any given time and so on. And then the... it gets more complicated too because they're depositors, and part of how the depositors are being paid is they don't have to pay fees to have their money in the bank because it being lent out is paying for all the conveniences and stuff that they're doing. Because if you actually had and this is a fractional reserve bank, like I deposit my money at the bank with the expectation that most of it will be lent out to pay for the services that I'm consuming, plus maybe a little bit of extra of a fee for me for my opportunity cost in lending the bank this money. There is such thing as full reserve banking. Zenus Bank, by the way, is a full reserve bank, and they're providing a bunch of services like storing the money for me and keeping it safe and providing a debit card and the ability to transfer it around and so on. And so as a result, they just charge monthly fees. I pay them to provide me with all these services because they keep 100% of the money on hand. They don't lend it out to anyone. And so, I have to pay them for this because they need the money to come to pay for their staff somehow. And since I'm the one who's consuming services here, it comes from me. So that's what full reserve banking looks like. Full reserve banking looks like I pay people to hold on to my money because my mattress is nowhere near as secure as putting it into a bank. It used to be nowhere near as secure as putting it into a bank when your money was actually like in coins or gold or dollars or something. So you want somebody with a gun and a big steel door on a concrete building to stand there and make sure nobody can steal the money, because that's a lot better than putting it under your own mattress. It kind of smoothly transitioned into, and then nowadays having your money electronically and having debit cards and stuff so that you're paying them for being the trustworthy people who operate this stuff and so on. And the electronic system smoothly transitioned over. You'd be paying for services one way or the other. Okay, what actually happens is, in fractional reserve banking, they then lend it out to pay for these things. But, that's, so the thing, it's so complex. This is the thing. If you actually get into what's going on, all of this stuff is all legitimate costs. They are legitimate compensations and at reasonable prices and so on. And so many of these things are getting figured in so that if you want to borrow money, your life is so much simpler. If you want money to invest in your business, your life is so much simpler. If you just have I want to borrow this, how much do I need to repay to compensate for all of the myriad of services that are going on in this complex economy? I don't even want to understand. I don't even want to know how many people are doing what, because it's not just paying for tellers, but you have to pay for the regulatory compliance people, and you have to pay for the oversight of this thing, and they're going to have an HR department, and people will have to take vacations and on, all of this stuff. And I don't want to think about that. I just want some reasonable amount of, tell me what is a reasonable price you would be willing to do this for. And I will pay that because I don't want to deal with all of this stuff. I don't want to deal with all of the complexity. Now, can I go to one person? Can I, scrounge around to everybody I know and everybody they know in order to find somebody who happens to have the cash on hand that they could just lend me directly that doesn't have any of this overhead? Yeah, I could. I don't want to do that either. I may not know anybody like that. It may take me forever. I don't want to spend all of this time asking for investment in my business. It's just not worth it to me. I would much rather, especially to expand a business, I would much rather, just take out a loan, pay a certain fee for the use of this money for this time, and then my life is so much easier. And so all of these things are being handled for me, rolled into these fees. And another one, by the way, is insurance. Because the thing is, we don't really have, anything. We don't have debtors' prisons. You can't, as in the parable of the unforgiving debtor. It's actually not normally called that. So it's the one where the guy owed a tremendous amount of money. I think it was a steward owed a tremendous amount of money to his master, and And then he begged and pleaded, and his master took pity on him and forgave the loan because he couldn't repay it. And then he met somebody who owed like 1/10,000th of what he owed. And the guy didn't have it and begged and pleaded with him for more time and to have mercy. But he didn't have mercy, and he had the guy taken and thrown into prison and turned over to the torturers. And then when his master heard this, he was incensed that, I showed you mercy. Didn't you owe it to show mercy, to your fellow? And then had him thrown into prison, and handed over to the torturers until he pays the last cent. We don't have handing people over to torturers in debtor's prison. That's not a thing. You don't have the ability to do that. And in loans, you're always bearing some amount of risk. Now, because the thing is, now I'm talking within the United States, because things get complicated, but for the most part, you don't really have debtors' prisons, and you can't get blood out of a stone. So at some point, if somebody doesn't have money, you can't get it from them. You can't take people and sell them into slavery, at least in most of the economic systems, modern economic systems I'm familiar with. Certainly not in the United States. So, you don't have what can be called full recourse lending. You don't have the ability to utterly destroy somebody's life in order to extract the money that you lent them. At some point, if they can't repay it, you're just outed. And you can have some amount of security. You can have you can have collateral. You can have put up this building as collateral. So if I can't repay the loan, you can have the building and sell it, or sell the building and you can get at least that much money. But the thing is, that's very frequently not, what the way collateral works is it usually is not, it frequently is not actually the full value of the loan. In the cases where the collateral is the full value of the loan, people can pretty much invariably repay the loans. Nobody puts up $100 million, nobody puts up $100 million building for a $10,000 loan and can't repay it and has to sell the building. So the thing about it is, since the lender is always in a modern system bearing risk, whether it's in corporate loans, which are a tremendous fraction of the lending that actually goes on, by the way, but in corporate loans, in business loans, there's the business. The business is a fictional entity, almost invariably. There are very few sole proprietorships that that really take out loans like this. So there's a business that owns the property and stuff, but basically the business can simply go belly up, be declared insolvent. You can, as a creditor, move to take as many of the assets of the business as possible and then sell them off to pay you back. But at the end of the day, if that doesn't pay you back, you're then just stuck with it. All right, that was all the money that's available for repayment. You don't get anything else. You can't do anything additional to try to force money out of people. And so you are bearing risk. Now, one of the things that is entirely legitimate, by the way, is paying for insurance. Insurance is a thing that has never been condemned. The bare concept. I'm not saying that nobody's ever done insurance in a way that is not condemnable. You will find everything done badly in this world. You will find everything that has been done wickedly in this world. But insurance as a concept is in we pool money, and then if something bad happens to one of the people who pooled the money, then we pay out of that up until there's no money left in the pool. There's nothing morally wrong with that. Well, so what goes on? What's one of the other fees that gets lumped together into the rest of the interest? Insurance. And now, in some cases, by the way, sometimes loans you will actually see there's insurance you can buy specifically for the loans. So this once with the car loan, actually, that you can buy insurance that would cover if the car gets destroyed. When the car is not worth as much as the value of the loan, so that it's called underwater insurance, I think it was. And there's some cases where you can buy mortgage insurance and so on, so that you can buy insurance against defaulting on your loans. But one of the things that happens is that one of the things that you could do, if you wanted life to be more complicated, is that you could be required as part of the condition of the loan as paying for insurance that has the lender as the beneficiary against you defaulting. Or instead of having to set up this separate relationship with somebody else and to make these payments and to have to pay somebody for all the time of verifying that you've actually done this with an approved lender and that your payments are all coming in on time, etc., etc., etc. Instead of all of that, you can just pay the bank a little bit of extra money, which will be called interest, for the insurance that they are doing for you. Actually, a curious thing, a lot of times what happens on mortgages is that the amount of money that you need to pay, the actual monthly payment, also includes basically, like, if you pay monthly, a twelfth of the taxes that are due on the house. Basically, because, like, if the house goes into tax foreclosure, it's awful for everybody involved. And instead of having to separately store up money so that you can then every year at tax time just write the check right then for the taxes that you owe, the property taxes that you owe, instead of that, you prepay the taxes to the bank, who holds the money in escrow for you. It's not theirs, they're holding it in escrow. And then when tax time comes around, the tax bill actually goes to the bank and they just pay it, because they've got the people, the professionals, who just go through and pay all of these things. And it's just part of their work, and they don't forget to do this. And so all these things all get paid on time, and no one has to deal with the awful time of defaulting on your property taxes. So that sort of thing, like everything becoming just like one simple, easy payment, is again a service that the bank is providing to you, and a thing for which, therefore, because they're doing all this work, they can justly be compensated for. And the amount of work that they're doing does basically scale with the amount of money that you're borrowing. So the interest that people pay on loans, in normal loans, and especially on business loans, it also works in like mortgages to buy houses and car loans to some reasonable degree. They're a bunch of sort of standard personal loans for which this thing exists. And so the thing about it, the thing about this stuff is, roughly speaking, that, like, for those things. Now, when we start getting to credit cards, life becomes a bit different. They're still primarily, like mostly what you're paying is non-payment insurance. Really, it's like a very high interest rate, and it is, in a strict sense, an interest rate. But most of what it's actually going to pay for is non-payment insurance, because if you don't pay off your credit cards promptly, there becomes this pretty high risk that you're not going to, and so they charge a lot of money. It's a complicated thing, and I don't want to get into credit cards specifically, because credit cards are... they're in the category of, as long as in credit cards you're paying off everything on time, then credit cards are relatively simple to defend. Once you start getting into the like 19% per year interest rates, like, it becomes a lot more complicated, the degree to which this is actually paying for services lumped into a single payment. And then, of course, you get into things like loan sharks, who incidentally are famous for engaging in full recourse lending, where they, loan sharks all maintain an associate named Vinny, who will break your legs if you don't repay your loans. And so they loan sharks famously both charge enormous amounts of money and fall into this category of full recourse lending, where they will, keep on hounding you without ceasing to get their money back, and then quite a lot more. So again, what I'm saying does not apply to loan sharks, and that's why actually in modern terms, or the modern term of usury or usurious rates applies to that sort of thing, because this is greatly in excess of any just charge for any of the myriad of services being provided. This is taking advantage of people who either don't understand what they're doing, or who are just in desperate circumstances, and extracting money from them, not for any legitimate things such as work that you're doing, risk that you are taking, opportunity cost that you are paying, and so on, but rather this is just doing the same thing that money lending in the ancient world pretty much only was, because they didn't have all of these other things that they were doing, and that is parasitically just extracting money from people because of the circumstances, where you can take this from them without giving them any sort of, where it's not a trade for compensatory good, but rather you're just extracting from them like a parasite. Okay, so that basically is, why does usury in the modern sense... by the way, etymology is kind of interesting, because it comes from use. It looks like usury, and that is, I think, actually some people, possibly British, pronounce it that way. But it comes from the word use, like it's money for the use of the thing. And it's a thing that in the ancient world, which didn't have approximately any of the stuff really in a widespread sort of sense that I just described as all the various things that you are legitimately paying for in a modern interest rate, because they were trading directly in precious metals. Like, if you gave somebody money, it was like a weight of a precious metal. There a lot of the time it wasn't even stamped with, it depends on where you were and when and so on. I mean, the Romans stamped currency. It wasn't always even stamped, and stamping of currency is just like basically somebody taking the trouble of guaranteeing the weight of the amount of metal in the thing. And even those guarantees were only worth so much because they weren't perfectly round and you could shave around the edges and yada yada. So like the guarantees were only worth so much. But you know, they're still reasonably accurate. But it's just a guarantee. It's just like the you know, whoever giving you a promise of how much metal is actually like sitting there, you know, you'd weigh it, you know, A, that it was made of that metal, and B, that it you know, not just like coated in the outside or something, and B, that it you know, was or looked like it, and B, that it was in fact the you know, appropriate weight that it should be. So you know, you could still have to like weigh things out and so on to make sure that it was the right amount of weight. But like weighing out metals and then having to agree on whose weights really are accurate here and so on, difficult. But that was really all it was. So when you're trading back and forth metals, there is such a thing as inflation, because as you mine additional metal, that's inflating the amount of currency actually. But it was, given the technology, the ancient world, relatively stable, except for fun fact. Another great way to inflate your currency is to go into a neighboring country, kill a lot of people, and steal all their gold and bring it back. And now you don't have more goods or services to buy around here, but you do have a lot more gold chasing them, and so you will get inflation. And thus you can pay for like more warfare to go steal things from other people. However, you could sometimes also steal lots of other things like cattle and pottery and people and whatnot. And then you do have, in addition to the more gold, more goods that money can chase, and so the inflation may not be so bad and so on. Anyway, digression aside, so the thing about it is the ancient world, lending money at interest basically only was loan sharking, because there were no so the money you're charging in excess of the legitimate services that you're providing, if you're not providing any legitimate services, is basically zero. So you can't charge money if you're not providing any services. You can't be charged money for those services, and so the actual legitimate interest rate to charge to cover all of the various services that you're providing is basically zero, because you know, it may not be your cousin named Vinny, and he might have been named like Vinius or something back in the day. But there were the people who would then go and like, you know, break legs and so on to get you back your money. There were things like debtors' prisons, and so you weren't taking risk, because you had, you know, things like the debtors' prisons. The risk you're taking was very, very incredibly minor, and you were doing everything you could possibly do to not take any risk. And you weren't employing people. There was nothing to invest your money in. Technology didn't have things such that there were businesses such that you could use money to expand your business and provide additional, you know, goods and benefits and so on. That wasn't really a thing owing to the state of technology at the time. Not that there was never any such thing as investment in the ancient world, but it was not very common and not very commonly available. So you don't really have an opportunity cost. You don't have inflation is not really a thing you have to take into account there, because like the amount of money that, you know, the money that you're using, you know, in precious metals, you're just directly trading into it. And so, yeah, like there's nothing you're providing by lending money in terms of, you know, additional services beyond the use, you know, temporary use of the money. And so and as somebody pointed out, the thing is, you actually are being provided a service, because when you have this money, you have to defend it. Like there's always got to be somebody home around wherever you are keeping your money in order to make sure that nobody comes in and steals it from you. You need to, you know, secure your house. You need to ideally have something that's awake and so on. Somebody or something that's awake, so that if a thief comes in the night, they, you know, can't take your money and so on. You will lend your money to somebody else. Now that's all his problem. His problem to make sure that he doesn't lose it and has it to give back to you when he's done. So he's actually providing you a service where you don't have to guard this money anymore. He does. So far from, you know, even further from providing a service, you're really getting a service by lending money in the ancient world, where like none of the modern economy or of the various facets of the modern economy apply. And so everything then was, any charging of interest in the ancient world was, slightly oversimplifying, in excess of in excess of any just price for any service that you are providing here, because the ancient world didn't have any of that. Now, that's why we are not rejecting that It's just that the modern world has a whole bunch of conditions that simply didn't exist then. And as long as you're in one of these conditions that did not exist back when, such that there are legitimate goods and services that you are providing, or services for the most part, here that you are providing that you are then charging a just price for, where you are then just simplifying life by lumping all of the, the just prices of all of the many services that are being provided all into one simple payment that scales with the amount of money being borrowed, because basically the amount of services you're consuming also scales with the plus opportunity cost, also scales with the amount of money being provided. What you're doing is not the same thing. You're not trying to extract money for nothing. You're not trying to drain a person of money without an exchange going on. You're providing services that are valuable to that person, being paid in exchange for the value that you are giving to them. And so that's basically an overview of why it is we're not rejecting what happened. It's just we live in a different context where there are a variety of things that can work out this way, which is not the same thing as what they were doing. From the outside, if you're not paying any attention, if you don't look into what's actually going on, you can see like, okay, there are some similar facets. And, in surgery, a surgeon is putting a knife into somebody, and in a robbery, somebody's putting a knife into somebody. But prohibitions on stabbing people do not prevent surgery. And we're not, if you tried to cite the do not stab people with a knife, but we like surgery, and so we're just rejecting tradition. No. You wouldn't be rejecting tradition by allowing surgery and still prohibiting stabbing people in a robbery. You would just be distinguishing that these two things are not at all the same thing. And the reason why the one is prohibited does not in any way apply to the other, because it's a different sort of thing that they didn't, that at the time of the first one, you didn't really go on. And so there's no reason to talk about it because it didn't exist. And so they didn't need to make this distinction because the one thing just didn't happen. Oversimplifying the history of surgery, obviously, because you do actually find surgeons way back, sometimes even doing something useful. Anyway, the point being, that is an overview of lending money at interest, how it is distinct from usury in the sense of the thing which is a sinful action, how that still exists. It is still possible to be usurious. It is still possible to try to take advantage of somebody's misfortune or ignorance or whatever, to extract money from them without providing them with value in return. So you're not exchanging money for value. That is still bad. Still in some cases, depending on exactly, but you can still, loan sharking is illegal. The usurious rates are, who exactly is regulating and passing laws and so on. So big and complicated, but basically you still have that sort of, you still have laws against that sort of thing because it's wrong and, it's predatory, taking advantage of people. So we still have the same thing. It's just we live in a much more complicated world owing largely to modern technology enabling the existence of all sorts of trades and actions and things that people need and things that people benefit from that didn't exist, and all sorts of benefits that people could not get and therefore couldn't possibly need to pay for. So that's where the thing that's an overview of the world we live in and why the people who say that lending money at interest is wrong in the modern economy, full stop, are wrong. They're basically trying to pretend that we live in an ancient economy when we don't. And basically they don't want to have to deal with any of the complexity of a modern economy, but they're also don't want to have to pay anybody to handle that complexity for them. They want the benefit of that complexity without paying for that complexity, and without by way of paying somebody else to deal with that complexity, or realistically, a large myriad of people, each who handles their human-sized portion of that massive complexity. Until next time, may you hit everything you aim at.